Good afternoon, Quasar Markets. Look, I've got him here with us again. You heard him last week. Michael Litt nailed it. 500,000 views, Mike. Let's be honest. That's quite a bit. And
somebody got that wrong. Must be 5,000. Five views.
Look, it's really interesting because you've hit the nail on the head. You're kind of seeing where the Trump administration is going. But to me, I need to understand the policies, the objectives of this.
Well, okay, let's jump into
the words that you said was widening out. Explain what you mean by that.
Well, we certainly are seeing a widening out in expectations. We're now seeing, even amongst the FOMC members, we're seeing a big dispersion in terms of where they see Fed funds rates in 2026. We're seeing something like a 1.5% spread amongst the FOMC member. We're seeing Edward Yardeni talking about earnings expectations widening out. We're seeing the Atlanta Fed and the consensus GDP expectations are widening out. So you've got a lot of much more dispersion in expectations right now than you've had historically. And so that's just what we're seeing.
Okay, well, let's get to it. I mean, there's so many people right now that are having this chat with their family members. They're having lunch and dinner, and they're walking outside mowing their yard, and they're talking about Donald Trump and his administration. And they're worried about Social Security. They're worried about the economy. They're worried about the stock market. Talk to me about the objectives of this administration, and especially in this case situation, cabinet members.
Good. For our viewers, then, that's a great place. Let's set some facts down. And I'm going to go to some research work I've done on actual things that Scott Bessent, our recently appointed Treasury Secretary, and Howard Lutnick, formerly of Cantor Fitzgerald, or currently of Cantor Fitzgerald, our Commerce Secretary. Let's talk about what they've articulated in some general plans and objectives, but some of the specifics underlying that, so we can set down what it is that's actually been put forth. I think in 2 weeks' time, when we do our next, let's do a part 2 on this, we'll talk about the implications, the risks, and the possible impact on the financial markets these objectives will have. But today, let's just talk about what they've actually said the objectives and the policies are. First of all, I think they observed that the budget trajectory would have been led the country no choice but to raise taxes. We just were running too high a spending as a percentage of GDP. Increasing spending when the economy is strong violated Keynesian economic principles, which says when the government should pull back or shrink its spending when the private sector is expanding. The Biden administration did expand government spending when the private sector was expanding, and that's part of why interest rates had to be raised. The other part, obviously, was the supply side shock to costs from COVID. Focus is on the lower 50% of households, and this administration, both Bessent and Lutnick have said it, they are not concerned with what the Northeast Corridor thinks. That's not normally how this government has been driven. That's a big change. The implementation is going to be driven by populist opinion, not Wall Street this time.
All right, well, let's get right to it. That's the policy administrations and their objectives. But, okay, tell me what they want to actually do. What's their policies then?
Let's talk about the three-legged stool, what they call the three-legged stool. The three-legged stool is the following. 1, cut the $6.5 trillion in government spending down. That $6.5 trillion includes $4 trillion of transfer payments that are Social Security and Medicare. They're going to get there by reducing the 5.9 million government workers and contractors, importantly, along with fraudulent transfer payments within the Social Security and Medicare system. They're also going to charge countries to sell their products to U.S. consumers. Those are the tariffs. That's coming from the Commerce Department. The cuts in government employees and fraudulent transfer payments are under DOGE, whereas the tariffs are coming under commerce, which is Lutnick. 2, second leg of the stool, eliminate taxes for those earning less than $150,000 and make the new lower tax regime stable and long-lasting. 3, deregulation, banks, housing, energy development specifically, cheap energy to accelerate economic growth. Those are the 3 legs of their stool. Now, spending cuts. The Bessent has articulated that pretty clearly, and that he needs to bring the deficit down from 6.5% currently to 3%, 3 to 3.5%. That's always been considered for a developed nation a sustainable budget deficit. Lutnick and Musk talk about a balanced budget. Mm-hmm. So if you hear about some disagreement on some of these things, what they have voiced recently within the last couple weeks, not the same exact thing. Okay, just to be clear. Bessent wants to get there by 2028. Lutnick and Musk want to cut $2 trillion in spending as fast as possible to get ahead of the lobbyists. That would be 7% of GDP. $2 trillion, just to be clear. Bessent cautions about not going too fast, as every $300 billion is 1% reduction in GDP. Now, I talked about the dispersion in growth expectations for our GDP growth. The mathematical model that the Atlanta Fed's nowcast is using has flipped into a recession for the Q1 of negative 2.4% growth. The blue chip economists' consensus has drifted down from 2.3% in mid-February to 1.6% today. Mm-hmm. Okay. Currently, our tax revenues are 18% to GDP. Bessent's fine with that. He would like to stay at 18% taxes to GDP, meaning our revenues, the government's revenues. But the 24.5% spending is not okay. And he wants to bring that down to about 20 to 21%, 21.5%.
Right.
Consistent messaging is that keeping the 2016 tax policy in place is not lowering taxes. They both repeat this many times in their discussions. It's simply keeping them level. Now, that tax regime has brought us a lot of this deficit, right? A lot of the accumulated deficit that got us to where we are was because we didn't cut spending while that tax regime was in place. Bessent has acknowledged that pulling this off is going to require economic growth to deliver on the deficit reduction objectives. Now, bank regulation, Stephen, right?
Yeah, let's do it.
Big topic for them. Bank regulation since GFC in 2008 has gotten too heavy-handed in their view. They want to limit small banks. It's limiting small banks lending to businesses. And we talked about this in one of our prior discussions, that has led to the rise of private credit because the banks' balance sheets are so constricted due to heavy-handed regulatory regimes coming out of the failure of the banking system. And Bessent supports the autonomy of the Fed on rates, which was a good message.
He does.
I've told you time and time again, that's the biggest risk. If the Fed loses independence, then we're moving one step closer to Argentina. But he wants to rein in the heavy-handed regulation that the Fed has put on the banks since GFC. He wants to bifurcate regulations where smaller banks are less heavily regulated than the too big to fail banks. And specifically, he's talking about something which I agree with, which is reducing the capital charge on those small banks holding U.S. treasuries. That would encourage them to hold U.S. treasuries, and it would incremental demand, like think of municipal bond rates are lower because the people will buy them at lower rates because they have lower taxation. It would probably, in his estimation, lower treasury rates 30 to 70 basis points, which would save $50 billion a year, plus lower base rates for all other borrowers, which has a big economic impact. I like that part of his bank regulation. I like that he took the foot off the gas on the White House sticking its finger in Fed interest rate policy.
Right, but and that's great. But I think the talk on everybody's tongue, including businesses and all the way down to Main Street, is tariffs, right?
Well, there you got tariffs are next. Remember that from our Secretary of Commerce, Litt's mouth is we need to charge people to sell to our consumers who buy $20 trillion of goods every year. Businesses around the world need access to the U.S. consumer, and this administration feels that they should charge for that. Now, they're going to press countries like India and Kuwait and others that have very high tariffs for level tariffs. Now, I think that people are hoping that they are just bluffing to get better deals. I think they're okay feeling more pain than the market thinks because they are appealing to the populace, not the Northeast corridor.
Right.
You see what I'm saying? So I think viewed as a primary revenue, they viewed the only revenue generator before we had income taxes in 1913 were tariffs, right? Yep. And they believe they can be an important revenue generator for us again. In fact, they call it the external revenue service, and that's what the administration calls it. Some acknowledgement of the inflationary impact. They do acknowledge it, but they try to get away from it pretty quickly in their discussions. It's something we'll talk about next time.
But the largest asset class in pretty much in the world, but especially here in America, is housing, right? And how are they talking about housing?
Right. Great question, and it's front and center. Housing drove this affordability, right, Stephen? It's housing affordability. Though I will make one last point on tariffs. Their inflationary offset in their policy mix is cheap energy, deregulation, and freeing up bank lending. So their belief is that's going to offset the inflationary impact of the tariffs. Now, housing affordability is a lightning rod for the populists. And Besant's view is that it is primarily driven by land scarcity, heavy local building regulation, and a need for more multifamily housing. Mm-hmm. They're bringing in and they're going to announce, I think next week, an affordability czar. And he is going after a number of the supply chain issues, which they believe are impacting both energy costs and housing costs. So they're going to take a proactive stance on this. It will have implications for a number of industries on a micro basis. But they are going to take a proactive view on housing because it was a big driver for the populists that put them in office.
Yeah. And, you talk about the populist, I guess I want to say rhetoric, but it's maybe a little different than that. They also said that they wanted to start a sovereign wealth fund, Bitcoin, and all kinds of things. But the Trump administration was very strong about a sovereign wealth fund, right?
Right. I call it the USWF. So okay. Normally sovereign wealth funds are called SWFs, but we'll call this one the USWF. So the USWF is gaining a lot of support internally. I think it has a lot of the idea of a funded pension system to support old age costs for the youngest cohort. And I don't think the details are fully formed internally. It's been too quick. But I think there's a lot of momentum and a lot of support for this. The ideas being discussed are, and Besant would like to see creativity in utilizing existing government assets to fund this, right? Yeah. Things like Fannie Mae and Freddie Mac. Land that they put into multifamily housing could be owned by the USWF, right? You could take the under 15-year-old cohort and say, this defined benefit pension system is for your benefit. And you've got 55 years till they're 70, which will probably be the retirement age you'll need. But now you don't have new people coming into the system as that cohort gets older and they become 15, 25, 35, right? They actually have a funded pension system. You have time to build up assets.
And do you think that some of those assets will be stocks too, U.S. stocks?
Yeah, Lutnick has a discussion where he's talking about buying stocks in companies the government is doing business with, so that we get a little bit of a kiss. It looked like government-sponsored insider trading, but I think what you do is I kind of chuckled when I heard it, but the truth is, I think what they do is they would diversify out of those initial assets they put in there into just like all other sovereign wealth funds, into a broad.
And would it be a lot like the ability for the U.S. government employees also to be able to invest like they do with tips, to be able to put part of their income and their investment into this USWF?
Whether it would be Bill Ackman has floated the idea of a defined contribution type portfolio. It would probably be easier to manage a defined benefit system if you're trying to diversify those assets in the first 2 decades.
I mean, you almost have to ask who gets it: Goldman Sachs, J.P. Morgan,
Well,
Stanley?
they should probably have some. You've got the one thing you do have in this administration is some smart Wall Street. Hopefully, they get some smart asset allocators that come from sort of my DNA pocket and get them in there to start thinking about this. You really have to be, as Scott Bessent said, creative, thoughtful, and really try to think about how you diffuse this issue for future generations, not just cut out the fraudulent elements in terms of the cost structure now, but how do we get ourselves into a much stronger position? We're a wealthy country.
Yep.
That we end up with a pay-go system now is actually a little bit of a failure on our part as a country. This USWF would be the smartest way we could go as a country. The IRS itself, Treasury Secretary Bessent, who oversees the IRS, said he has 3 goals for the IRS: revenue enhancement, privacy of information, and customer service. He wants to keep the IRS now Lutnick has expressed his objective slightly differently with respect to the IRS, where he wants to squash the IRS. So there's a little bit of a disagreement on the IRS, but I think Bessent is clear that is a very, he's not happy that there's 500,000
Right.
people working at the IRS. I think a lot of the government, automation, there could be a lot of government automation.
Yeah.
They have a concept of these employees who are donating things to the government, their time, like the Doge, and software can be donated. I think what they're going to try to do is there's no question we can improve automation and the systems on which our government operates. I think the last one is the newest one, Stephen.
And you talk about it being a wealthy country, and I'm going to pull it up right now. I think you've said it yourself. Trump and the gold card, right?
The gold card, yeah. So I don't think people understand what the concept is here. And this is part of their policy mix. The gold card versus the green card, and the play on words with the Trump card, is for foreign nationals to buy a gold card, and they will have the right. Now they will not become a U.S. citizen, but they have the right to become a U.S. citizen if things in their country go sideways. So
it's not an automatic golden ticket into the country. It's just a quicker way to get back in.
Well, it's a quicker way to citizenship.
Okay.
You would have to pay U.S. taxes. What their hope is that these people set up, households here, family wealth management, offices, and start businesses here. They're entrepreneurs, and
right.
So what they're hoping is to attract wealthy, this cohort of the immigration population would then set businesses up here, pay taxes in the United States, and I think that is not the $5 million is one thing, but the bigger deliverable is that these people. I mean, so many immigrants have started successful businesses that employ so many people here. I think the idea here is, hey, let's keep attracting entrepreneurs. Let's keep attracting business builders. Let's keep attracting job creators to this economy. While you can laugh at the Trump card on its face value, again, each of these has an objective. So that basically lays out a skeletal framework for what they really have articulated as clearly as I can discern it in my Switzerland, trying to stay in Switzerland in my neutral fashion. Now next time, Stephen, let's talk about, because if you are going to lay off 1 million, 1.5 million of the 5.9 million workers, they have to reset in other jobs. Those people buy coffee and donuts from a local store, right?
Yep.
You don't lay one person off in isolation. There are there are ripple effects from those actions. The time it takes to reset and pot those people into new productive pursuits and get the income flowing back to the coffee and donuts guy, that's the kind of stuff we're going to talk about next time.
I look forward to that.
View of tariffs. They don't buy into how economists see. Let's talk about those things and the implications. And those are the implications that are creating this widespread in expectations for inflation, interest rates, growth, earnings. Earnings expectations are going to start to widen out. I said that 2 weeks ago, and we're starting to see the outer winds of that hurricane now. We were oversold 2 weeks ago when I said you had 60% bearishness amongst retail investors. That's come off a little bit. You're more in a neutral territory right now. But let's focus on these structural issues here now and for 2 weeks from now. Let's look at the implications. I've got a lot of homework to do and a lot of reading to do to try to think through the first, second, and third order implications. But we're going to stick with this policy mix that our administration has put forth and appears to be implementing on a rapid pace.
And I'm going to change your title to Michael Litt, Trump administration chief explainer here. I think that sometimes you have a lot of people that just are a little bit confused, and it's a little, you almost wonder if it's a little dodgy, this administration, and of how they're handling it. But you being on Wall Street as long as you have, I think you kind of understand their thinking about the future and how they would handle, in this case, the tariffs and the deregulation and bank regulations and housing. I think you kind of give us a better overview of what they're thinking and how they want to handle it. Is that correct?
So certainly the administration is populated with people that came from the same background that I have. So maybe it gives me a step up in understanding where they're coming from. My understanding is President Trump listens to everybody in the room and then thinks about it, makes a decision. His decision making is very unique to his history, his views, but he's felt very strongly about this objective set. He wrote, a 1-page piece in the Wall Street, I think it was the Wall Street Journal in the 80s about a lot of it. It was the basis for this. He's putting into action what he truly believes philosophically. So
I agree.
The implications are that for risk assets and investors and asset allocation and markets. That's what we should try to derive, right? Because that's how you anticipate markets. And
in all fairness, it's what made America great in the first place, right? Was the investor class and taking risks and building and housing and real estate in his case, right?
Absolutely. I mean, you clearly, this is a business friendly administration. And it's the everyman friendly administration.
Well, let's clarify. I think it's more U.S. business friendly, right?
Well, okay. It's U.S. business friendly, and it's global trade on fair terms friendly.
I like that. Okay.
Right. And things like the U.S. The WF, I think, are exceptionally good big ideas. We've got a lot happening at this, all in the same moment. And look, again, staying ahead of the lobbyists may be one of the reasons you observe this moving so rapidly, because there are a lot of interests who have their hands in that $6.5 trillion cookie jar, who don't want you to cut $1 trillion out of that.
Right.
Take $1 trillion of cookies out, right? But the truth is, it's not their money. It's the taxpayers' money. It's the future generations who have to pay that debt down's money. So what the administration's objectives are laudable on a lot of levels. How we get there, how quickly we get there, the process by which we get there, and if some of those, the plans to get there don't work out. That's what we want to discuss next time. We don't know the answers, but let's talk about, I'll try to get some really good stuff on, but this helps lay the groundwork for what I believe are the primary, the skeletal structure, and we'll put some meat on the bones next time we talk.
Love it. Michael Litt, global investment strategist to the sovereign wealth funds and my friend for many years. Thanks, Michael. We'll see you next week.
Thank you.